There is a strict mechanical paradox in the market cycle. Hedge funds routinely lose billions betting against companies they believe are mathematically overvalued, while technical operators generate massive returns shorting companies with flawless balance sheets. This discrepancy introduces the valuation short seller. This is an investor who initiates a short position entirely because a company's price-to-earnings ratio appears illogical on paper. They are graduates of the University of I am smarter than the market. They look at a soaring stock, declare the buyers foolish, and rely on their own disbelief rather than respecting the physical flow of capital. This chart proves the outcome of both approaches. On the left, we see Netflix from 2009 to 2011, tracing a massive upward price curve against a heavy volume of short interest. On the right, First Solar in 2008, dropping in a precise near-vertical cliff. As Netflix climbed, the sheer volume of buyers absorbed every short order in the book. The rising price mathematically squeezed those valuation sellers, forcing them to buy back their shares at heavy losses, which only accelerated the upward ascent. First Solar's 68.6% collapse was entirely different. It was triggered not by a sudden shift in its business model, but by a mechanical exit of institutional capital that overwhelmed the remaining buyers. Short selling is the purely mechanical extraction of capital during the transition from institutional accumulation to distribution. Between 2012 and 2014, Tesla became the ultimate trap for smart money trading on valuation. When institutional investors decide they must own a piece of an emerging industry, massive forced buying drives the asset into aggressive upward growth. This is the accumulation phase. This graph illustrates Tesla's trajectory during that exact window. As the price moves aggressively from $60 to $290, the PE ratio overlay line expands right alongside it, stretching up to 100 times forward estimates. That multiple expansion is a mechanical feature of high demand. It is not a pricing error waiting to be exploited. Price strength creates its own gravity. As the stock climbs, strict portfolio mandates force fund managers to buy in. You can track where valuation shorts stepped in at resistance bands. Instead, liquidity violently broke through, liquidating their accounts. Portfolio managers are graded against peers. If an asset becomes the market's leading issue, they are mandated to own it, regardless of what the underlying math suggests. This dictates the absolute first rule of the short side. You never short a stock while it is in an active accumulation phase. Attempting to step in front of that kind of institutional buying power using nothing but a spreadsheet guarantees the destruction of your portfolio. If an inflated valuation cannot trigger a collapse, we must isolate the mechanical signal that does. Broad market collapses do not occur instantaneously across the entire economy. The breakdown occurs through asynchronous rotational topping. Specific leading sectors exhaust their capital and fail months before the broader market rolls over. Look at the macroeconomic breakdown leading into 2008. The earliest signs of capital exhaustion materialized here, in rows of unfinished houses and stalled construction projects. The housing sector actually hit its peak in July of 2005. That is a full 2 years before the financial crisis seized the broader system. From there, the distribution pressure spread outward. The timeline shifts from the housing collapse in July 2005, jumping directly to the breakdown of the financial sector in May of 2007. Even as banks fractured, capital rotated to technology stocks, but eventually the pressure overwhelms the system. The Nasdaq surrendered in October 2007, and remaining tech leaders succumbed in January 2008. Once the macro breakdown begins, it follows a strict structural anatomy. Capital destruction unfolds in a sequence of predictable downward waves. We can see that exact structure on this chart. The index traces a distinct multi-wave descent, punctuated by 3 massive downward legs. By the time the market enters that third or fourth wave, the sellers have capitulated. At that moment, the risk of a violent, liquidity-driven reversal back upward increases exponentially. Effective operators do not try to guess the absolute top. They track leading assets 8 to 12 weeks after their peak, waiting for mathematical confirmation that capital is moving out. Understanding macro rotation tells you when to act. Surviving volatility requires precise tactical execution. During moments of panic, the architecture of the market fractures. When buy-side bids completely evaporate, the order book empties out, and prices enter a freefall. This chart maps the daily price action of Research in Motion, now BlackBerry, during the distribution phase of early 2010. Notice the 50-day and 200-day moving average lines acting as critical thresholds. Technical short entries are triggered by a heavy volume price break, tearing straight through key moving averages. Right here, the price gaps down and snaps the 50-day average, marking the exact mechanical entry point. What follows is a liquidity crush. Rapid, panic-driven selling floods the system, exhausting the order book and forcing remaining investors into capitulation. As a short seller, you must aggressively buy to cover your position directly into the teeth of that selling panic. As the asset plunges toward the $63 level, stepping in guarantees the liquidity needed to exit. If you wait passively for a clean bottom, you will be caught in a low-volume bounce, surrendering profits. Instead, extract your capital, wait for a natural bounce up to resistance, and execute a new short position. The mechanical edge does not come from holding a static position. It comes from aggressively recycling capital between structural breaks and these extreme moments of capitulation. This animation isolates the operational difference between the two philosophies. On the left, a static short position is squeezed upward indefinitely by institutional demand. On the right, capital is dynamically deployed, shorting structural breaks and covering into price spikes. Trading on fundamental disbelief is an academic exercise that fails under the pressure of actual market mechanics. The market is entirely indifferent to opinions on corporate valuations. It operates strictly on the physical flow of institutional liquidity. The protocol requires strict patience. You must wait for the massive accumulation phases to fully exhaust themselves. Next, you track the broader macroeconomic timeline, identifying those 3 to 4 rotational downside waves to confirm the transition into a bear cycle. Finally, you execute at the tactical level, enter on high-volume technical breaks, and aggressively cover your positions directly into liquidity crushes. True short selling is the highly disciplined mechanical navigation of an asset's inevitable structural distribution.